Welcome back, everyone. Thank you so much for joining me. Let's talk about the US labor market. There are very bad signs that you might want to be aware of. The US labor market is showing alarming signs of underlying weakness. According to recent data in May, full-time employment dropped by 623,000 jobs. 623,000 jobs, the fourth largest monthly decline in the past 5 years. It also marked the second monthly decrease so far this year. So as a result, the share of full-time jobs in the labor force slipped to 79%, which is the lowest reading, the lowest level since August of 2021. This reading has actually been trending downward for 3 consecutive years. The ongoing decline in labor intensity suggests weakening demand for full-time positions. Warning signs in the job market are really becoming difficult to ignore. Now, there is even worse news for young college graduates. Despite their degrees, despite their internships and debt, of course, we can't forget that, many recent college grads are actually hitting a wall, and not just anecdotal. According to the New York Federal Reserve, labor conditions for recent college graduates have, quote, deteriorated noticeably in recent months. Unemployment for new grads now stands at 4.8%, and this is an unusually high level. Even MBA grads from top schools are struggling to find work these days in the United States. Meanwhile, law school applications are surging, echoing the bunker mentality, if you will, of the 2008 financial crisis. So what's really going on? Let's talk about the possible reasons for this. There are 3 scenarios that I will include in today's video. First, the labor market for young people never fully recovered. Not from the pandemic and maybe not even from the Great Recession. After 2009's peak unemployment, the recovery was very long and it was very slow. Many companies froze hiring or downsized, which made it especially tough for young people without any prior experience to enter the workforce. Then, just as the economy seemed to rebound, the pandemic hit. Inflation spiked, as you might recall. The Federal Reserve raised interest rates to cool demand, and that cooling hit white-collar industries really hard. Tech was especially slammed. Job openings in software and IT operations plunged, and since 2022, around that time, software programming job postings on Indeed have dropped by over 50%. For new grads hoping to break into tech, into consulting or finance, the market just isn't what it used to be. Not anymore. Now, the second theory is much deeper. College no longer delivers the same edge in the labor market that it did maybe 15 or even 10 years ago. According to research from the San Francisco Fed, 2010 marked a turning point when the lifetime earnings gap between college grads and high school grads stopped growing. That was back in 2010. Now, at the same time, fewer online job listings are asking for college degrees. College still pays off on average, of course, but the problem is return is less predictable. And with rising tuition, the uncertainty feels more risky, and so many people choose not to go to college. The shrinking college premium is good news for non-college workers, of course, but it does add a new layer of pressure for those who did go to school and now have an enormous debt to pay off over the next many years. Okay, so what is the third theory? And this is the scariest one. Artificial intelligence is actually quietly transforming the economy and not in favor of recent grads. Think about it. What are entry-level white-collar workers often tasked with? What are they tasked to do? They're reading and summarizing information, they're producing reports, they're creating presentations, and so these are exactly the kinds of tasks that are outsourced to generative AI, and it can perform them very well, virtually at no cost. As companies adopt AI tools, they may be finding that small and tech-savvy teams can do the work of larger junior staff groups. So that is going to be a major issue for new grads moving forward. And of course, it will make some professions completely obsolete in the near term. This brings us to something economists are calling the recent grad gap, the difference between the unemployment rate of young college graduates and that of the overall labor force. For decades, that gap has been positive. Young grads have historically had lower unemployment because they are relatively cheap and they're freshly trained, so they typically didn't struggle to find entry-level roles in their professions. But last month, that gap hit an all-time low. That happened last month. That means today's college grads are facing worse job prospects than the average American worker ever did. That's never happened before. This may be what it looks like when entry-level white-collar jobs begin to disappear in certain professions. And I would argue that that is exactly the case. That's what's going on. In law firms, for example, AI is taking over paralegal tasks. In consulting, teams are using AI to replace entry-level analysts. In tech, elite developers are using AI to co-pilot, and that actually replaces junior coders. So the entry level might be shrinking before our eyes, and it is something that is driving the labor force changes that I mentioned in the very beginning of this video. And of course, downturns don't help either. Historically, recessions speed up technological change. Companies use economic slowdowns, economic downturns to shed less efficient workers, they lay people off, and so they double down on productivity, often through automation, of course. Even if AI isn't directly replacing jobs at this time, high spending on AI infrastructure may be diverting funds away from hiring. But before we jump to any conclusions, it is fair to be skeptical. For one, we're not yet seeing explosive productivity growth, the kind that we would expect from an AI revolution, so it hasn't happened yet, and it's likely not going to happen within the next couple of years. And according to the New York Fed, most firms say that AI is having a negligible effect on hiring so far. Although, of course, they would have to quantify what they mean by negligible for that statement to hold any real meaning. However, that is what the New York Fed is reporting. LinkedIn's chief economist also isn't seeing evidence of large-scale job loss from AI just yet. Instead, she says many firms are just playing it very, very safe, and to cut costs on operational expenditures, they are laying people off, and we will see more layoffs here in the United States moving forward as the economy continues to slow down. And these firms, these companies are focused on short-term margins, and so they are likely to lay people off to please their shareholders, and they are not actually eager to invest in entry-level talent at this time, especially when training takes time and they are diverting funds to AI resources. So what does all of this mean? Whether it's lingering effects of past recessions, a structural shift in the value of a degree, or the early stages of an AI-driven transformation, the job market for young graduates in the United States is definitely very, very clearly flashing a yellow light, while the overall US job market is clearly flashing red light. We're going to see more downward revisions of previous months moving forward. And of course, increasingly, this situation is pointing to a considerable economic slowdown waiting for us ahead. Please remember to show your support, like, subscribe, and share. It goes a long way. It really means a lot to me. Support my work on Substack and Patreon. You will find them linked in the description below. And I will see you back here tomorrow. Bye for now.